So hi everyone. I have here Eric Schaanning, who's talking to me from Denmark of all places. He probably will tell you more. But I meet all sorts of people in my office, and I rarely meet somebody where I know they know so much about things I know so little about, and I find myself drawn in. And so Eric is a mathematician. He's a very, very good mathematician. He studied at ETH here in Zurich originally, and he's been at Imperial College, and he has connections coming up at least to other great universities, and he's clearly in demand at banks to help them manage their balance sheet and their balance sheet risk. And we have all read a lot about this topic, but I promise you that the journalists who write the articles that we read don't know as much as Eric does. And I just got super excited when I discovered that Eric was teaching a course on risk at the University of Zurich, at which point I kind of said, that's not fair. I want to know about that. And he said, come to my course. And I said, I don't have time. And we agreed that we would do this podcast video. So this is a different kind of podcast video because I said to Eric just now, it's a kind of a personal tutorial, if you like, or a personal seminar that everybody can eavesdrop on. So with that, Eric, and before we dive into your slide deck, teaching deck, why don't you I'll just say hello to everyone, and I'll give you a chance to correct all the mistakes I've made in the introduction. Ladies and gentlemen, I give you Eric.
Thank you very much, Guy. What a pleasure and honor to be here with you. Yeah, no corrections to be made. I read your book a couple of years ago as it was recommended by a friend, and quite unbelievable to sit here now doing a podcast with you after having seen William Green and Luca Delano and many others on your show, you could almost say. So really excited to talk about asset liability management and interest rate risk in the banking book with you.
Yeah, and just
Thank you
before
for
we
having
get
me.
into it, I'm slightly nervous because I'm convinced that one of these days Eric is going to wake up and realize how little mathematics I actually know. And I was the proud person to have Eric join a lunch where one of the people was a maths prof. I think one of the people at the lunch was a Fields medalist, which is a big deal in the world of maths, and I'm kind of still in awe of it. And I would tell you what I'm also in awe of, and we're going to get sort of like the knowledge to understand this. Very interesting. It's right now it's a research paper that's just been distributed, and the interest rate risk banking book, IRRBB, which we're going to learn a lot about. But I read through this. Well, I didn't read all of it. I was telling Eric that I read parts of it and skimmed other parts of it. But I'm in awe of anybody who can assemble such a document. So with that in mind, let's dive into I guess it's kind of like a reasonably quick or an overview. We'll see where it goes. We're going to discover how much Guy actually knows. So we're going to dive into the title is Asset Liability Management and the interest rate risk in the banking book. But there we go. And I presume that I can ask questions when I want to, or should I raise my
Absolutely.
hand?
No, please. Yeah, you don't have to raise a hand on the call. So any time you have a question, please interrupt. And
Yeah.
yeah, this is my first podcast recording. So this is about asset liability management and interest rate risk in the banking book. Short disclaimer, of course, that these are my personal views and not those of Nordea, where I work with. And let's start maybe with a quote by Warren Buffett. Not only applicable, I guess, in the world of investing, but also in the world of asset liability management or risk management more broadly. Risk comes from not knowing what you're doing. And I found ALM and IRBB to be quite elusive concepts, if you will. They're not as straightforward as credit risk management or other risk stripes that are maybe more tangible because it really interlinks the whole balance sheet and it matches assets and liabilities and how you jointly manage it too. So a bit of an outline what we would talk about. First would be an introduction or motivation why this is a relevant topic. It has come to the forefront, of course, after Silicon Valley Bank in March last year. Then go a bit of an overview of the regulatory framework, some fundamentals, which is a little bit technical, but that's, I think, needed such that we can dive deeper into the other topics afterwards. Fourth section would be about the risk measurement and management of interest rate risk in the banking book. Then we can do some slightly advanced topics. NMD replication. NMD stands for non-maturing deposit, which is a bit of a jargon for your average site account, for instance, that is not locked with an interest rate in contrast to a term deposit, for instance, and hedge accounting. Then bit of strategy around asset liability management, maybe some future challenges. I think it's relevant to talk about some case studies. So I've picked out Silicon Valley Bank, and then given you're based in Switzerland, Credit Suisse and UBS, where we can look at their balance sheets and what the interest rate risk is on those. And then to finish off, a deep dive into the paper that you've skimmed through. Any questions so far?
Oh, thank you. I was on mute because I was chomping on a biscuit, but fantastic. Thank you, Eric, for doing this. And very briefly, I guess this is you use these same slides when you do, or similar slides when you do the course on risk management that we
Yes,
talked
exactly.
about.
This is a slightly abridged version of the course, and those who've missed it last year, this is maybe an extended teaser if you want to join it next year. So on a motivation, as I said, ALM really is, I think about it like the cardiovascular system of a bank. It's not your muscles or fat that can absorb shocks to the body, but it's really linking the lungs and the heart. So if you look at two, I think, prime examples of ALM failures in the past, recently there was Silicon Valley Bank. Everybody has probably heard about that. The long story short is they had invested the short-term funds from their customers, which were redeemable at a very short notice, into longer-term securities without hedging the interest rate risk. When rates then rose, so coming out of the low interest rate environment, and in 2021 to 2023, rates rose dramatically across major economies. That led to unrealized losses on these securities, but the unrealized losses led to effectively Silicon Valley Bank being insolvent. And due to that effective insolvency, a depositor run then triggered or was set off. And this led to a realization or partial realization of these unrealized losses, and the regulator had to step in to stabilize the bank. And that's quite similar, or strikingly similar, if you look at the savings and loan crisis in the US. Again, in a period with low rates where long-term fixed rate mortgages had been issued by the S&Ls. And then when rates rose, the S&Ls had shorter term funding. So the liabilities were repricing at a faster pace than the loans. And they essentially ended up in a situation where the funding was more expensive than the lending. And this led to major insolvency and bank run. So you can see a picture of depositors queuing there from May 1985.
So I do want to step in and ask a question. I just need to be wary of going down a rabbit hole because I know that at the end of this, there will be a whole new language and a different language with which to talk about this. So if Silicon Valley Bank had been able to play out their hand, so they reached for yield and invested in longer duration bonds than they should have, and the prices fell as interest rates rose, and that all would have been fine. Well, not fine, but even the accounting allows you to hold those bonds as bonds held to maturity, and therefore not even to recognize the price loss in your balance sheet. That would have been fine if they'd been able to play out their hand. But what Silicon Valley Bank discovered, as I understand, and you'll correct me, is that those deposits, the duration of those deposits, so if the assets were long-term bonds, the liabilities were bank deposits, and whereas they made an assumption that bank deposits were there maybe for an average of 3 years, it turned out they weren't even there for 3 weeks.
Yes.
How am I doing?
If the depositors had stuck around, it would have been fine. SVB might have run into a similar problem as the S&Ls because over time, as rates were rising, customers probably would have wanted a higher yield or a higher rate on their deposits. So SVB would have needed to start paying more on the deposits, but the interest rate that they were earning on the securities portfolio was locked. So the
Yes.
margin that they were earning would have been squeezed over
Yes.
time.
Yes.
The proper way to mitigate the risk would have been to interest rate hedge the asset side. That would, of course, reduced some of the profits that they were making when rates were low, but it would have hedged them effectively against the risk of rates rising. And
last point to you before we allow you to continue with your presentation is that I found it remarkable that some banks, even though they had the same issue, actually were recipients of deposits. So there was a flight to safety. And if you were a large money center bank, despite the bank having this mismatch between assets and liabilities, they received deposits. And so, that for me is interesting that there's a benefit to being big enough that people perceive you to be safe, despite the fact that you were facing the same issue on your balance sheet.
not necessarily. So you do face the same issue from a liquidity perspective. Deposits, especially the non-maturing ones, are contractually redeemable at notice. But you definitely don't face the same risk from an interest rate perspective. You could essentially get fully rid of interest rate risk, and then regardless of the level of rates, you would just earn a more or less fixed margin. So
Yeah.
that risk you can get rid of.
So back to you, Eric. Thank you for the intervention.
Okay, so let's quickly look at what happened in Silicon Valley in a bit more detail as a motivation. Silicon Valley Bank was a bank with roughly $200 billion in assets and providing banking services to startups and tech companies in Silicon Valley. So they had quite a concentrated customer base, which was one of the problems. And as rates rose, you saw essentially that the big red chunk on the left, held to maturity investments, these bonds, they were losing value. So you get the same rate, but when rates increase, then all else equal, you would want to get a higher rate on that investment. Now they had locked in the rate that they were earning on that. At some point, depositors realized that the bank essentially was insolvent if you accounted for these unrealized losses. And then the non-bearing interest rate deposits on the bottom of the liabilities, they started to leave. So if you have a term deposit, it means you lock your deposits for 3 months, 6 months, a year, then you can't withdraw it, and the money has to stay with the bank. But if it's a non-maturing deposit, you can withdraw at will. So 42 billion then left, and 42 billion, if you compare that, that's essentially cash. So the bank needs to pay these out in cash. If you look on the left side, they had 13 billion in cash. So you're hard pressed to pay out 40 billion if you've just got 13 billion. Then before they started to liquidate the held to maturity investments, which would mean you do realize the unrealized losses now and they become actual losses, they were taken over. The US authorities stepped in, but effectively the bank was both insolvent and illiquid. And sometimes in the news, you also see that Silicon Valley Bank was growing at a very fast rate and that their net loans or the lending didn't grow in a commensurate way with the deposits. I think that's not really a key problem. The key problem is rather that the interest rate risk wasn't hedged. So if you turn all the held to maturity investments into loans and you don't hedge the interest rate risk of that, then the problem is still the same.
Yeah.
Then the net fair value of your lending book will decrease as rates go up, and you're essentially in the savings and loan crisis. So the issue is really about interest rate hedging rather than whether the funding that you get from the customers is placed into loans or into held to maturity investments. And then the second point really was the concentrated customer base. So anecdotal evidence was telling that people were in WhatsApp groups, and then some VCs were telling their startups to withdraw all of the cash. So then, of course, you've got an even faster snowballing effect of customers trying to leave the bank.
A brief question for you. You talked about Silicon Valley Bank being illiquid and insolvent. So my understanding of illiquid means you might have a positive book value, but you just can't put your hands on the cash. In this case, in theory, 40 billion leaving, they had available for sale investments and cash. So in theory, they could have, without having to have realized any losses on their 91.3 billion held to maturity, they could have presumably met that provided they didn't have any more. Uh, uh,
Yes.
but so they
Well,
were,
you're still short 9 billion. You need to pay 42, and then you've got 13 in cash and 26 in. I'm bad at mental arithmetics, but
well,
yeah, I think you're still
they're still
short.
slightly short, slightly
Yeah.
short. So that would imply, at least based on looking at it, and many of those held to maturity investments would have been highly liquid. There would have been mortgage-backed securities and things, but they would have had to have realized a loss. So that's the sort of being illiquid. When you say insolvent, you're saying if you were to convert at market prices the whole of the asset side of the balance sheet to cash, and
Yeah.
it would have not covered all of the liabilities effectively.
Exactly. It would have absorbed the whole of shareholder equity. So that's
Yeah,
about 13, 16 billion on top.
yeah.
So the losses, this is your book value, but if you then market to market, the loss that you need to take um, exceeds the shareholder equity. And so
Uh,
if you sell the held to maturity investments, then you do need to market to market. The other option is that you repo it to the central bank, but the central bank is still going to give you a haircut
yes.
because effectively what you're posting now is worth less. Um, yeah.
So just to explain the mechanics of a repo to the central bank to somebody who's never heard that word before.
Yes, essentially you pledge securities to the bank, securities that you own, and as a function of that, you get an amount of cash from the central bank that you can then use to pay other banks or customers. And there is a haircut that's applied. So if you post $100, say, to the Fed or the S&B, they might haircut the securities and then say, we're going to give you 90 in cash. And when you repay the cash to the central bank, then your collateral is relieved.
And what would they have charged for that repo?
That would be certain. It depends on the facilities. So you've got different central banking facilities. You've got regular monetary policy facilities. Then you've got discount windows. You've got emergency liquidity assistance. These different facilities have different rates attached to them. But it's generally based on market rates or policy rates plus a certain amount of basis points
Yeah,
above
but
that rate.
it's a facility in that they're not trying to make money off you and they're not trying to price gouge you, and the bank has
Yeah.
the ability to basically find liquidity and to continue to take price risk on the security. They're kind of the ones who either lose or benefit as the security moves. And in this case, the security would have appreciated to maturity at a higher interest rate, so they would have made their money back. So they had some ways to get liquidity
Yeah.
out of the central bank, not having to go to the market, basically.
Yeah.
If you, just out of curiosity, I mean, presumably the person managing the assets, the held to maturity investments at Silicon Valley Bank would have been on the phone to the Fed, talking about potentially depositing a whole bunch of them in return for liquidity.
Definitely, I would
Yeah,
say. Yeah.
yeah.
Um,
Um, I think it's also interesting for me that you're talking about a 200 billion balance sheet and 16 billion in equity. That is not if it's not a high leverage ratio. It's not quite 10%, but it's not far off either. And I think that when you come from the world of Bear Stearns levered 30 to 40 times on their equity just before the financial crisis,
yeah.
uh, you're talking about a crisis and an insolvency at a bank that was not particularly leveraged, which I think is really important. It was a kind of a shock to all of us. Last question for you. Why do you think that, I mean, the understanding that when interest rates go up, the value of your long-term bonds declines by a significant amount if they're a 30-year bond, say, and not interest bearing. Why do you think that the people on the asset side just didn't pay attention to that?
It's a good question. I don't know. I can try to guess.
And
One one guess would be because rates have been low for so long, people just believe that they'd continue to be low for longer. Certain central banks, I think in 2021, were issuing a report where they compared what rates were going to do or likely to do going forward, and they analyzed the back to normal versus a low for longer scenario, and the conclusion was it's not. We think it's not going to be low for long. We think it's going to be lower for even longer. So lo and behold, a couple of months later, rates went through the roof. I think it was
Yeah.
maybe linear extrapolation of past couple of years.
Around that or before that time, there was some study that came out, I believe, from the Bank of England that The Economist published, talking about how these people who made this study, and I wish I could reference their names, wanted to show how there had been a secular decline in real interest rates over centuries. And the conclusion from the article was we're now in a world of close to zero interest rates for a very, very long time because we're just producing so much capital and there are so few places for the capital to go, was the idea. So back to you, Eric. Thank you.
Thank you. So I thought briefly to give an overview and make matters concrete, let's look also at the balance sheet of UBS. This was before the Credit Suisse takeover. And I often like to think of this in terms of an X, if you will. So you've got on the left side the assets, which are producing returns, but also bear risks. And that's buffered, or the losses there are absorbed by equity. So you've got total equity on the bottom. And it's quite similar if you think about liquidity rather than capital. So you've got your deposits and various funding instruments on the right. And then on the left-hand side, you've got cash and central bank balances that are highly liquid. So these are similar to the equity that absorbs losses in terms of credit risk, if you will. You've got cash and liquid instruments that absorb funding losses, and you're really trying to manage the combination of all of this.
Yeah, so let's
Um,
just, if we can just go through it for somebody who takes it in slowly. And I think, Eric and I both have, we first of all are going to do multiple topics in one podcast. Then I said, no, this is too good. We have to do, so we're going to get Eric multiple times. And even this, we're going to divide it into, I think, two sections. But I think it's worthwhile to just walk through, to walk through the left side, the asset side, and then to walk through the liability side and just talk about the nature of each one of those things.
yeah,
I think everybody pretends to know, but few people actually do. So why don't you just go section by section and talk about the nature of those assets, what they look like, all of those good things.
yeah. On some of the more elusive one, I might even be on thin ice, but I'm going to talk through the main ones to give the key idea. So let's maybe start with the biggest item, if you will. So loans and advances to customers. That's your mortgages, credit lines, consumer mortgages, the lending, really the
So
yeah.
for everybody's benefit, we're on the left side, we're on the asset
Yes,
side,
on the left
and
side, and we're talking about 387 billion
yeah.
of loans to customers. Um, then the other big chunk is, as you can see, liquid assets. So cash balances at central banks, also loans and advances to banks. This tends to be more liquid. This is 184 billion. So that's essentially the 13 billion that we saw before on the Silicon Valley Bank. And you can see this is a much bigger proportion of the balance sheet than what Silicon Valley Bank had. Then you've
Actually,
got,
sorry,
pardon?
Eric, this is so fascinating. If you do, could you just turn back to the Silicon Valley Bank slide
Yeah.
a second? So for what it's worth, and if actually you see it, so if we look at the green cash and available for sales, I mean, somebody like me, in the article, Eric talks about a YOLO bank, you only live once bank. So somebody like me could show up, or Eric, or you, if you're listening to Silicon Valley Bank and say, you know what? Bonds look really good. I'm going to take 3 billion today and I'm going to buy bonds. And so that cash would have gone from 13 billion down to 10 billion. It's as easy
Yeah.
as that to move it around and the other way around. And then so Eric's point, if we just go back to UBS now, is that their choice of cash as a proportion of the balance sheet is just way, way higher. It would
Yeah.
be easy enough for somebody to show up here and say, oh, I think I'm going to take 100 billion and stick them into whatever it is. It could be short-term treasuries, in which case it would count as cash, or it could be 30-year bonds, in which case
Yeah.
it doesn't count as cash. And sorry, just one other thing. So um, maybe you can. I loved learning about duration and what duration means, but so I would imagine that and I'm gonna tell you what I think, and then you're gonna correct me, and you're gonna explain duration. So we've only looked at two
Yeah.
of the categories here. So
Mm.
I would imagine that the cash literally means whatever number it is, I can call it today and send it wherever I like, and wherever it arrives, it'll be the same number. I've got no issues. That number is good, to use a Charlie Munger expression, good until reached for. Now we talk
Yes.
about loans and advances to customers, and if we just take real estate loans, loans against real estate, could be other loans in there. But first of all, you can't liquidate those loans. You can't call up the customer and say, that 5-year loan that we gave you, we need the money today, please.
No.
Some of those will be in default even potentially. So there'll be all sorts of categories within that.
Yeah.
But so can you tell me where I'm wrong? Correct me, but also help to understand it in terms of how would I think about the duration of the loan book?
No, this is correct. You can't go to customers. Well, you can, but that effectively means you're out of business, right? If you go
Yeah.
back to customers and say, "Can we please have the money back because we need to pay out some depositors?" I think that's a good advertisement strategy. The duration. There's several concepts of duration. One, the weighted average maturity, for instance, you look at all of the cash flows that you get. Let's take a bond, for instance, or loan portfolio, and then you look at if it's a bullet loan, that means you've got no cash flows until the end maturity of the thing. Then the maturity and the weighted average maturity are the same because it's just at the very end when the bond or the loan matures or expires, for lack of a better word. Then you have amortizing loans, which would be the majority of mortgages, for instance, where you make down payments on the principal. There, the duration of the loan will be smaller because you're essentially waiting or time waiting the cash flows of the product. And
Uh,
yeah,
yeah, no, you go ahead. Finish the thought.
yeah. So essentially, for instance, if you've got the same payments on a monthly basis over, let's say, a year, then your weighted average maturity is half a year, right?
Yes.
So going from a bullet loan of 1 year with a 1 year duration, having this spread out over monthly or weekly or whatever payments, then reduces the weighted average maturity.
And obviously, this is a very large balance sheet, and we're just
Yep.
having a bird's eye view. We have no idea whether the duration of the loan portfolio is 1 year, 5 years, it could be 10 years. And we also don't know. I mean, I found it interesting talking to a real estate developer in the United States, and I don't know how the rules are applied or what underwriting rules banks have. A a loan that you make against a development property where there's construction work going on is different to a loan made against an interest bearing or a rent bearing producing property. I
Yes.
learned that it's very, very rare in the United States for a loan to be made for development without a personal guarantee in there
Oh,
by the
good to know.
developer. So even relatively large firms and well-established firms, the banks will try and require a personal guarantee, which is a whole different level of security, meaning that if the loan goes into default, you can basically reach for all of the principal's assets, including personal homes and what have you. None of that granularity is in there for what it's worth. We don't know exactly what that loan book looks like. And it's a
Now,
source
there
of,
are disclosures required. I'm not sure if it's also on the duration of the asset. You might find it in. I can
yeah,
check maybe for the as a follow up for season two,
yes.
on the duration of the loans. But banks are, for instance, required to publish information now, regulatorily required to publish information on the duration of deposits and their funding. So
So
that has that's falling under Pillar 3, which we'll get through. So public disclosures.
for what it's worth, everyone, I was expecting you, Eric, to start at the top of the balance sheet, just work your way down, but because no, it's really interesting. So I just want to give people insight into how, risk averse people or smart people who smart with risk think. So Eric just naturally went to the largest item first, or the largest item on the asset side of the balance sheet. So I'd love to go through all the other items. So back to you
Yeah.
for all the many other items on the balance sheet.
The next one I'd pick would be the trading portfolio. That's essentially your trading book, or the largest part of the investment bank would generally sit there, unless if you think about corporate loans, for instance, if that's issued from the investment bank, that would again sit in loans and advances to customers. But all market making activities, security, inventories, if you have, let's say, an IPO that's arranged by the investment bank, then the bank will first issue the bonds, send it to the market. They will hold an inventory of these bonds, and that will sit in the trading portfolio. So that's 108 billion here, and then the repos that we talked about before, and also reverse repos, those will sit in securities financing transactions, and you'll see that on the right-hand side, so the liability side, you've also got securities financing transactions. So repos and reverse repos show up on asset and liability side. And then you've also got, for the trading portfolio, you've got liabilities. That's generally derivatives where you've got a liability. So that will show up on the liability side. But if you've got a positive net present value on the derivative, that will show up on the asset side.
I know that there have been debates over whether, in what cases can you net the two sides off of the transaction against each other and just show an equitized value on the one side? In what cases do you have to show the underlying sort of notional on both sides? I mean, there are many, when you talk about a bank's trading book, there'll be many transactions where what the trader wants to claim is just the equity value of the trade. And what I imagine somebody like you wants to do is you want to show the notional and both sides of it. Is now a
Yeah,
moment to.
I know actually not too much about that. That gets you into counterparty credit risk management, where you look at so-called netting sets. So if you've got many transactions with one counterparty, then you would net across that counterparty. But maybe you've got similar transactions with a different counterparty. So if transaction 1 with counterparty A is offsetting with transaction 2 with counterparty B, you can't net it because it's against two different counterparties. But if the two transactions were against the same counterparty, you can net it.
Yes.
And there's many quite detailed rules around defaults, how essentially you run through the closeout netting of such exposures.
Now, another question for me arises if I'm sitting in the CFO's office at UBS in this case. I know that I can, if I have the trading portfolio and they are liquid securities, then I can get a pricing. They might not be a correct price, but I can get an objective price. And so information is flowing in a better way, in a more clear way. If we're talking about the loan book, then information bubbling up about loans that are in default or are not current interest pay would appear to me to be far more difficult to get a view over and to be able to track. And really, if I try to explain the little that I know, if you're in the CFO's office, you can't be sure that the information systems you've built in the bank are rock solid. You don't know where there might be pockets of people who just really do believe that the loan will come good or didn't feel like they had to report so there's a whole risk attached to just reporting on the loan book, or has there been underwriting, a decline in underwriting standards, which there may be a decline in the trading portfolio or the securities portfolio, but at least you can see the consequences pretty quick.
Yeah. There's quite a lot of regulation around reporting, especially under IFRS, which is an updated accounting standard. And so once customers, for instance, get into arrears and they haven't paid the interest rate, immediately that's what should happen. Your loan switches a category from being performing, and then you've got certain levels of, are you in arrears in 30 days, 60 days, 90 days? And at the end, you then come into a defaulted state where the bank will then try to essentially grab, if it's a mortgage, they will foreclose your house, grab the collateral, and then pay off the loan. And you get, if there's anything remaining above what you owed the bank from the sale of the house, then you get that money back. But that's what would happen. And you've got many steps essentially until you get to that state, and that should generally happen in a fully automated way.
So thank you. Back to understanding all the different categories. I'm curious to see where you go next.
Yeah. So next, I think I would pick equity on the liability side. I'm skipping other on the asset side, the 190. It's big, but yeah, difficult to say what's in there. Some of the things that are in there are um, goodwill items, for instance, or property, premises, and equipment. So assets that the bank owns. If you own your own um, offices, for instance, but it's not really relevant from a risk management perspective. It's more relevant from an accounting perspective. So on the right hand side, then total equity, that's really your loss absorbing funds or capital. Um, there's several layers of equity. So you've got common equity to CET1, then you've got tier one, which is common equity tier one plus additional tier one. There was a lot of press around Credit Suisse's additional tier one bonds when they were written off by FINMA in at the peak of the crisis. So that's the difference between CET1 and tier one. And then you've got tier two capital and also bail-in capital. So that's essentially the hierarchy of how losses are absorbed. Um, Debt issued designated at fair value. These will be bonds. Similarly, long-term debt issued. You can choose to fair value your issued debt or to accrual account it. That's often a accounting or finance decision. But from a risk management perspective and from a funding perspective, this means you issue bonds to investors and you get cash in return that you then put to work on the asset side. And debt issuances, they can vary between a couple of years to, I think 10 years is probably the longer cycle of what you'd issue, but generally it can be 1 to 5 or 1 to 10 years. And as mentioned, some of it is bail-inable, so it can either be written off or it can be converted to shares. Bail and convertible to shares simply means if a certain trigger event happens, it can be either a low capitalization of the bank or the regulator can step in and say, we're going to trigger this on our authority, then you're no longer a bondholder, but you certainly find yourself being a shareholder.
So two things. So I love those bail-in bonds because so effectively for those who are interested, presumably you're interested if you're listening this far. What happens in many restructurings is that debt gets converted into equity, and in a sense, bail-in bonds basically tell the creditor, the debt holder, in the event of certain triggers, this is the way in which your debt will be converted into equity. So rather than it being a negotiation at a bankruptcy court, it's a done deal, and everybody knows it was a done deal. So that makes sense to me. I think that to my limited knowledge, when I look at a balance sheet like this, two things. One is obviously there's the huge knowledge that Eric brings to what's behind it, but I also find interesting presentational quirks. So it would bother me enormously that there's 93 billion of other, including net derivative liability, so low on the right-hand side of the balance sheet. So given what the way it's been described in this diagram, I would kind of be expecting it to be in somewhere up in the shorter term part of things. And so it's both a large number and it also seems to be in the wrong part of the balance sheet. Are you able to talk to that?
No, I wouldn't know. I would have to read some of the footnotes in the annual
In the
report
annual
where I
report,
grabbed
yeah. So I'm diving
the
deeper. So
picture.
Eric, just for everyone, Eric put this up for just for sort of like illustrative purposes, and I'm doing, but I think it's not. It does it bother you the way it bothers me, or
Not at first sight, no.
because?
Good question. I would probably look into why the other on the asset side is so much larger than the other on the liability
Right,
side. So
right.
if you got 100 billion differential, then can I disentangle these 100 billion into something more concrete and then map it? So if you've got 100 19 other assets and 19 other liabilities, at the size of this balance sheet, given that it's roughly a trillion, um, it wouldn't strike me as peculiar
So,
at
and I
10%.
think that before we move on to other categories, so often we never get to the bottom of it. But I've experienced now with the balance sheet of Aker Marine Fund or the accounts of Aker Marine Fund that, there is a conversation that will happen between us and the auditors to how to characterize something. And there are all sorts of considerations that go into that. On the one hand, you don't want to unduly concern the investors. At the same time, you need to reflect it accurately. And so for me, it's not about getting to the bottom of what every single bit of those $93 billion is to try and get a sense of why they decided to categorize it in that way. And in my case, is my view this is of concern to me? Is that the best view? Is it Eric's view? No, it's not overly concerning. And what the answer is got to do with the story of how it ended up like that. But that's a whole rabbit hole. Let's go over the other categories that you want to go over before we flip
Yeah.
slides. And we're only on slide 2 of like 220 slides. But back to you, Eric.
So then we've got customer deposits, which I think is the same. If you ask the average person on the street, what's in a bank, they will tell you loans and customer deposits. So these are really the two big categories, and then equity will probably come third. Now, customer deposits then disaggregates into 4 categories here. Time deposits, I would say, is the easiest one. That's just a locked up deposit for a certain amount of time. So 3 months, 6 months, a year. You would rarely see people locking up cash for more than a year, although it exists. And that means you get a fixed and higher interest rate on these deposits, but you can't withdraw it before the maturity of the deposit. The other side of that is the band deposits. So generally, you would get no or very low interest rate, but generally no. These are current accounts, which customers, both private retail customers, but also companies use for their cash management, paying salaries, paying the rent, etc. That's 181 billion. Now that's essentially the main bulk of the non-maturing deposits. So contractually, they're overnight. But if you then look at how they behave, they have what's called a modeled duration. So even though contractually people could withdraw the money today, the 181 billion don't leave today unless there is a real crisis. So in your business as usual operations, you will assign a certain duration to these deposits that's modeled and different from the contractual duration. And that will allow you to fund a part of your asset side, because let's say you for sure knew that customers were not going to leave within 3 months. Then you could fund a 3-month loan with this cash, because you would know, which we assume for sure, that customers wouldn't leave within 3 months. So then you can take this money and fund that. Then you've got
And
retail savings. Sorry.
what comes up for me, and for example, the 3-month interest rate may be 80 basis points higher than
Yeah,
the overnight rate, and that's a real return on that.
absolutely.
Um, what I also find interesting is that even just if you break down the deposit side of the balance sheet, they represent different business models. The business of generating demand deposits is probably quite capital intensive, requires you to be able to process customer payments, employee payments, supplier payments. And so you generate the demand deposits, but you need all the infrastructure to allow the client to move the money around the way they want to, as opposed to, saving. Well, there are other kinds of deposits where you don't need as much infrastructure, but it's also less sticky. But you're
Yes.
going to get into that.
Yeah. And retail savings deposits are a bit similar. So you can have restrictions in terms of withdrawing money from a savings account. Generally, it would be a small penalty. So as long as you put in money to a savings account, you get a higher interest rate. And if you withdraw, maybe you get a fee or you get a lower interest rate, which helps the bank understand and model that these funds are less likely to leave. They're not blocked in the same way as time deposits, but they're still stickier than demand deposits. And then sweep deposits, that's generally related to brokerage accounts. So if you have a trading portfolio and you've got excess cash that sits in your brokerage account, that can be swept into these so-called sweep deposits, and you'll earn a higher interest rate. There's differences between different banks, so I don't know exactly how UBS is doing it, but that's a general idea of a sweep deposit. And I
Yeah.
think then the other important category I'd still single out on the liability side is short-term borrowings, and to some degree also the securities financing transactions that I mentioned before. Short-term borrowings is money market instruments. So if you don't want to use cash that you've got on hand, but you think you just want to have a bit more, you can issue commercial deposits or commercial paper. So it's often abbreviated CDCPs. That will be short-term borrowings, which you borrow in the money markets, in contrast to the long-term debt further below on the liability side, which is generally the capital markets desk that issues these.
I dream of the day when I have found the commercial paper market to be utterly fascinating because
Yeah.
the way it evolved was it started with just IOUs, and these IOUs exchange bills turned out that, if you had an IOU from XYZ, now you would have A-rated corporate issuer, then people would hand that around because the IOU was good for the money. So that sort of became a tradable
Mm.
instrument, which is just kind of fascinating. The way the market for commercial paper from industrial companies is kind of like part of the money market is just for me a kind of a fascinating thing, which and yeah, anyway, a bank like UBS can issue as much short-term paper as it likes, basically, and it's all good for the
Yeah,
money, basically.
yeah, pretty
And
pretty much.
this,
Then
yeah,
yeah, one also an interesting observation. I think you did a PP in Oxford, so I'm not
yes,
going to be harsh on the economists, but if you look at the classic economic literature on banks, um, a lot of that focused on banks as intermediaries between savers and borrowers, and that's not entirely true. So we do talk about here deposits funding loans, but there's a really interesting quarterly bulletin by the Bank of England, which is called Money Creation in the Modern Economy, and which shows that banks essentially, to some degree, create money out of thin air. So you don't, if a customer comes in and wants to get a mortgage because they want to build a new house, the bank doesn't need to go and issue a bond or find the deposit in order to issue that loan. The bank's just going to say, here's your loan. And if, let's say, you're going to pay this on the day, if the person that you're buying the house from has their account in the same bank, then actually nothing happens. It's just a book entry value that changes. So the balance sheet will grow by a billion or a million. Billion is an expensive house. So you'll have a million more loans on the asset side. You virtually have a million deposit by the customer who took out the loan, but then it's paid to the other customer. So it just switches from that customer to the next. So the balance sheet just grew by a million on the asset and on the liability side. If the customer now is in a different bank, then of course the payment you will still have the assets grown up by one, but now the customer with the account in the other bank needs to be paid. So then the cash is going to go down by a million, and UBS is going to wire to another bank, wherever the customer is, a million to pay the house. So you've converted essentially, you first up the balance sheet, and then you've converted cash into a loan. So this is happening all the time essentially. But the key point is you really don't need to go and get a million for a customer if they want to have a mortgage. And one
But
key difference, interestingly, is the Danish mortgage market, where effectively every mortgage does have a bond that's issued against it. And you can then either redeem at par or you can go and buy your own mortgage bond in the market. But that's really a peculiarity, I'd say, of the mortgage market in Denmark. That's not how it's in most countries.
so I can tell everyone that it was when I was doing PPE, studying economics at Oxford, when I discovered this concept of the fractional reserve banking system, that it's the banks that create the cash that drives the economy, not the central bank. It was kind of miraculous to me. Um, a question. I'll make a point and then I'll ask a question. Different countries can run their fractional reserve banking system differently. They could even abolish fractional reserve banking if they wanted to. And one would ask, and every now and then you get these sort of like people who worship sober banking, say, who want to abolish the fractional reserve banking system. And the simple answer that I would give them is that yes, you can do that, but the result will be less growth in the economy. So it has the effect of tamping down economic
Yeah.
activity massively. And definitely an aspect of banking regulation and of controlling the money supply is to allow the money supply to be loose enough that it allows for productive economic activity, but not so loose that it creates froth and it creates too much economic cycles. So that was the point. And then I had a question which has just escaped me. But so first of all, do you see it the same way? I guess is an obvious question to that point.
Yes, I think that to a degree banks can and do create money out of thin air. And the limit on this, you can't do this ad infinitum. The limit to this is regulation. So you will have capital requirements. For instance, if you start issuing more and more loans, you will have to hold equity against these loans for the credit risk. You will also have liquidity requirements depending on the loan issuance. So you'll get into trouble there as well. So regulation is going to put a stop to how much you can do this, and also then the central bank policy. So what are interest rates doing? What's the funding cost in the economy that the central bank is steering? These three components will effectively steer the bank's ability to do that. And there are also, for instance, borrow-based measures that will also steer this. So, for instance, a lot of Scandinavian countries have limits on what's called debt service ratios or debt to income. So, depending on the customer's income, there's a threshold of maybe you can have 4 to 5 times your annual gross income as credit or as mortgage, but not more. So, if you then think about the aggregate economy and apply that restriction, then essentially the upper bound by just that constraint would be 5 times the whole country's annual income.
Yeah.
So there are many of these constraints that then work together.
Do you think well, there's a whole literature, and we could have an interesting debate and conversation about how one strikes that balance between security in the banking system. You can see different countries strike that balance in different places, and it's a fascinating area of conversation. And in a sense, what we're looking at here, we're looking at private institutions' desire to optimize both objectively the risk in their balance sheet. Obviously, according to the regulations, the regulators are trying to optimize. We don't want financial crises too often, if ever. At the same time, we want to maximize the opportunities for growth in the economy, and the rules and regulations that are made have a huge impact there. But let's keep going, so that and I
Yes.
hope that I mean, this is a really, really fascinating topic, and they say that central bankers, and I may even say risk managers, are a different species of banker. And we're close to the central banking ideas here, and it's on the one hand extremely rarefied thing, and at the same time utterly key to how capitalism runs, and we're kind of getting close to that here. So
Yeah. I mean, so far, I've still spent the majority of my career to date in central banks. So it's fascinating to see the topic now from the other side of the table.
Yeah, yeah. Um,
Um,
I would
I'd
have
go to
enjoyed.
the next, pardon?
Yeah, yeah. You go ahead. I would have enjoyed being a central banker or working at a central bank. So, yes.
So
So
this is a bit of an overview now of what I thought we could talk about. I don't know how people did it before ChatGPT or DALL-E to add pictures to slides. IRBB in a nutshell. I'd start off with the regulatory framework in the next couple of slides. That's the box on the right. So there is, interestingly, no minimum capital requirement for interest rate risk in the banking book, but there are Pillar 2 and Pillar 3 requirements, and also so-called supervisory outlier tests. And there's three categories of risk: gap basis and option risk, that are the main categories in which the regulator thinks about interest rate risk in the banking book. If we go below the nut, products, I think we've went quite well through the different products: loans, deposits, whether it's fixed or floating, sight or term deposits, and then interest rate swaps, which we'll get into a bit later, and also bonds. Then on the left-hand side, these are metrics. So net interest income and delta net interest income, as well as economic value of equity and delta economic value of equity. These are the two key measures how you measure interest rate risk in the banking book. And the regulators paying quite close attention to these, but banks also pay attention to these for the management of interest rate risk. Then rates as such, there's many different interest rates. So when people say interest rates have risen, it's there's govy bond rates, there's corporate bond rates, there's mortgage bond rates, there's swap rates. If you think about interest rate swap markets, there's lots of policy rates, SARON in Switzerland. Then you've got new OIS rates, so overnight index swap rates that have come into place after the LIBOR scandals. So IBOR stands for interbank offered rate. Most of these rates have now been replaced by new alternative reference rates. And then some of the other important concepts that we also had on the top slide. So hedge accounting, funds transfer pricing, CSRBB, that's for credit spread risk in the banking book. And on the right hand side, strategic decisions. But I think I won't dive into those now. We'll get through them step by step.
and just
But
to
that's an overview of the topic.
And just to clarify where we are, so we've looked at the overall balance sheet of a typical bank. We've gone and looked at Silicon Valley Bank. We've looked at UBS, and the question we're trying to answer is, so we're separating out now just the loan book, so that kind of illiquid part of the asset side of the balance sheet, and we're asking the question: how much capital do we need to hold? How do we know that the bank can absorb whatever might happen to that loan, well, to the loan book, correct?
Mhm.
Am I am
To
I
the
am I
interest rate
right?
risk in the loan book.
Right. So as a from both from the CFO's office or from the regulator's office, are they holding enough capital, basically,
Yeah.
against this, is what it comes down to.
Yeah.
What's the risk of either uh, um, illiquidity, insolvency, bankruptcy, basically?
Exactly.
Back to you.
So let's start then with the definition of the banking book. And the funny thing is, there is no explicit regulatory definition of what the banking book is. Generally, the way it is defined is that you define the trading book and which instruments or which categories of products and instruments fall into the trading book, like what features do they need to have. One is that you should have a trading intent or short-term resale here. You should seek to make profits from short-term price movements, or you make markets, for instance, in bonds or shares. And then everything that's not in the trading book is in the banking book, which is why it's sometimes also called the non-trading book. Um, but for all intents and purposes, I think the way you can think about it is the banking book tends to hold all of your mortgages, the lending to customers, and on the liability side, the banking book tends to hold the deposits of customers. And then the trading book is trading instruments. Bit of a tautology, but I think that's conceptually the thing. In terms of accounting standards, there are also important differences. The banking book will generally be accrual accounted, and the trading book will generally be fair valued. You can have fair valued items in the banking book and vice versa, but the majority will always be fair valued in the trading book and will be accrual accounted in the banking book. So it's a bit of a Potter Stewart, I think, was the judge who then said, "I see it when I know it, or I know it when I see it." And it's a bit similar here with the products, how you classify them on into banking book or trading book. Now, interest rate risk in the banking book then refers to, this is the definition from the Basel Supervisory Framework and the Basel Committee on Banking Supervision, so BCBS. And that's not binding regulation, maybe just to take a quick step back. The BCBS sets standards, which is then the Basel framework. And then national jurisdictions or regional jurisdictions like the EU, they go take these standards and implement them into local law. And that's then what the banks or financial institutions need to adhere to. So the Basel framework in the EU, for instance, will then be transposed into CRR and CRD. Now I forgot what the operations capital requirements regulation, I think, and the capital requirement directive. I hope that was correct. And these will be the binding requirements. But you will have quite a close alignment between the international standards defined by Basel and local regulations. So IRBB is the risk to current or prospective both capital, that's the economic value of equity perspective, and the earnings perspective. So the earnings perspective refers to NII, net interest income, and the earnings perspective looks at what's the stream of cash flow that you will get over time, versus the economic perspective looks at what's the net present value of that stream of cash flow. So you might still get the same cash flows. So there's no movement in terms of net interest income, but because rates have gone up, the value of that cash flow has actually been decimated. And that's why you've got these two perspective. And I think it's, yeah, we'll get into this in more detail in the next couple of slides. This is an overview of the supervisory framework. So as I mentioned, there is no minimum capital requirement under Pillar 1 for IRBB. That means for each additional mortgage, say, that the bank is issuing, the bank does not need to hold an additional unit of capital. That's completely different in credit risk. In credit risk, you calculate risk-weighted assets, and for every unit of mortgage that you issue additionally to clients, you have to hold capital to absorb unexpected losses. So that's a big difference between the two. There is some discussion around whether that's right or not. So for instance, Pablo Hernandez de Cos, the chair of the BCBS, he's said, I think last year in following the Silicon Valley Bank crisis, he was throwing the idea around that maybe you should capitalize interest rate risk in the banking book. Now, I'm not going to comment, so neither take a position in favor or against this, just saying that is has been debated in the past, and I think debate has become more relevant again after Silicon Valley Bank. But we'll get also to Silicon Valley Bank and how that relates to the framework that was in place. Then Pillar 2, that's what falls under the supervisory review. So you need to run both internal stress tests, but also regulatory prescribed stress tests. The regulatory prescribed ones, these are the so-called supervisory outlier tests. BCBS prescribes one, and that's in the majority of the jurisdictions, that you run a supervisory outlier test on economic value of equity. So I'll start using abbreviations because it's a bit of a tongue twister. So the EVESOT is the economic value of equity supervisory outlier test. The EU has now also implemented recently this year an SOT on net interest income. So that's the NII SOT. That's Pillar 2. And under Pillar 2, you can have an additional capital requirement, but that will be mandated by the supervisor. So the supervisor can come in and say, we really don't think you're managing your interest rate risk well. That's why we're giving you an additional capital charge. If you, for instance, fail the supervisory outlier test, you can be called, not automatically, but the supervisor can designate you as running excessive interest rate risk. And as a result, then charging you more capital. So then you do get a capital charge, but that's because the regulator assesses you to not manage your risk well. You do not need to hold the capital automatically one for one under Pillar 1, which is different than to credit risk, as mentioned before. And
And
then Pillar
just,
3,
sorry,
sorry.
just to be clear, when we're talking about pillar 1, 2, and 3, we're talking about just a sort of a framework that was
Yes.
maybe just take a, we're going to assume no specific knowledge. So maybe you can just take a second to talk about very briefly banking regulation in some major economies, the role of the central bank versus maybe, so if we take the the United Kingdom, you have the FSA and you have the Bank of England, or here in Switzerland, you have the Swiss National Bank and you have FINMA. And then, how these get tied together internationally, ending up with this amazing Basel Committee and the Bank for International Settlements. Blast away, Eric.
Yeah. So there is a difference in how countries manage this. You've mentioned for instance, the SNB and FINMA. There you've got two different institutions. SNB is the central bank. It issues the currency. It's the bank of the country. And the central bank will also have obviously a monetary policy goal, which will be the primary target. But many central banks will also have a financial stability mandate. So if you think about the crisis of Credit Suisse, then SNB was not the intervention of the SNB there was not under its monetary policy and price stability mandate, but it was acting under its financial stability mandate. Now, FINMA is the supervisory authority, so banks need to comply in order to operate. So in order to get a banking license, which is a prerequisite to have an account at the SNB, these banking licenses, you get them by fulfilling banking regulation requirements. And it's FINMA, or the supervisory authority, that will check whether you do comply with these or not. And FINMA will then also generally set your capital requirements. Now, this can become murky because there are, for instance, macroprudential capital add-ons that can be mandated because the authority can mean either the central bank, it can mean the supervisory authority, or it can mean the macroprudential authority if that's different from the central bank and the FSA. Sometimes that's the Ministry of Finance, so that you get the government involved. That authority can set a buffer across the entire banking system. So it's not targeted at a specific bank, but that authority then says, we think that systemic risk, for whatever reason, is large in our country. So we're going to mandate additional capital requirements to the banks. But that's, I think, in a nutshell, maybe the both regulatory and central banking framework. So you'll have a central bank, a macroprudential authority, and a supervisory authority. And whether these three are completely disjoint, whether it's one entity doing all three roles, I think you've probably got all combinations if you look at the different EU countries and globally.
And just so a bank in the United States, I had the privilege of visiting the old Treasury business building, which is not opposite, but on the side of the White House. And the U.S. Treasury is the one that is in charge, for example, of enforcing anti-money laundering in the United States and making sure that money from, say, rogue states like Iran or North Korea doesn't make it into the banking system. And so, in a sense, if you're an American bank, you certainly have deep dealings with the central bank because you're doing repos and you're doing all sorts of transactions with them. You might be bidding in a government. Well, then you have dealings with the Treasury, and then you have dealings with the supervisory authority. So you've kind of like in a way got at least three, possibly more different
Yes.
regulators. But then, it's an institution that I don't understand all that well. But and again, for fun's sake, I guess, all the way through World War II, the Bank for International Settlements met
Mhm.
in Basel and regulated the world's financial system, and representatives from both the Allied powers and the Axis powers got together in Basel to discuss the world's monetary system through World War II. So you had Germans and Brits sitting around the same table. Can you tell us, you know way more than I do, about the Bank for International Settlements and the supervisory or the regulatory role that they play, which is, I think, where this sort of risk framework is coming from?
I'm on very thin ice, I think, historically on the central banking history and the role of the BIS. I'd have to get a friend in from the Norwegian central bank. He would know this just off the top of his head. But the BIS is essentially the bank for central banks. So in the same way as we have an account at uh, Credit Suisse, UBS, Nordea, whatever bank you want, that's commercial money. Um, and the banks will have an account at the central bank. So they have central banking money in their accounts. Um, the way you can convert one form of money to the other is by holding banknotes. So if you go to the ATM and withdraw money, you're essentially converting commercial bank money, so commercial 10 Swiss francs into central bank 10 Swiss francs, because now you hold the note and the liability is on the SNB. Previously, it was on your account and the liability was on UBS. And if UBS defaults, then you've got, of course, the deposit guarantee scheme, etc. But if you have more than 100,000 Swiss francs in your account, then maybe you won't get to see the excess. So it's really, as long as the system works, it doesn't matter. Nobody thinks about that a currency conversion with a one-to-one FX rate, if you will, between private money and central bank money happens. But if you withdraw money in cash, that's essentially what happens. And the BIS, in the same way as we have our account at a bank and they have accounts at the central bank, the BIS is a bank where central banks have accounts. So if central banks make payments, for instance, they can move money around on their accounts at the BIS, and that's why, from a financial system perspective, it's an absolutely crucial institution, and also why, in a war situation, then during World War II, it plays an absolutely central role.
Central banks can net off against each other as well. I mean,
Yes.
they can make payments in all sorts of ways, but it's interesting that they all have accounts with this BIS. And it turns out that Basel has become, the Bank of International Settlements has become a kind of a central place to discuss banking regulation in all of the Western economies. And this you gave it the name BSCS, I think.
BCBS, yes, the Basel
Yes.
Committee on Banking
So
Supervision.
so tell us briefly about that, and tell us about these three. I think they talked about these three pillars before coming back to your slide.
Yes.
Thank you.
So the BCBS, Basel Committee on Banking Supervision, they're essentially a forum of predominantly central banks, also supervisory authorities, and they agree at an international level um, what regulation should look like, ideally. So, and it's important because if given and so it's both important and it's become more important, I would say, because we're so interconnected globally. So if you have a jurisdiction where banking regulation is significantly more restrictive or severe than in another, it will be more difficult for banks to be profitable in that jurisdiction. And you will have probably, if that's allowed, you will have foreign banks with lighter requirements starting to provide more banking services to that economy because they have a lighter capital charge. So it's really important for the level playing field across the jurisdictions that you're well coordinated um, across jurisdictions. And then, um, if you think about the Great Financial Crisis, when you try to improve the stability and the safety of the system, um, yeah, there are these two objectives, if you will. One, improve the stability of the system, and two, do it in such a way that you're not creating an uneven level playing field for the participants across different jurisdictions.
And so they've come up with these three different levels of protection of balance sheets, basically. There's a whole area of just to go,
Yes.
there's a whole area of interesting stuff that one could go into around how these
Many rabbit
regulations
holes.
unfold. Which is fascinating, utterly fascinating. And this is the plumbing of the banking. This is the plumbing of money, basically.
Yes.
But back to pillars one, two, and three.
Yes. So we did pillar 1 and 2. Pillar 3 is public disclosures, so market discipline. And the idea is by setting certain requirements on the banks, what they need to disclose, investors will then stop lending to certain banks that take on too much risk, and essentially market discipline will ensure that banks do manage their risk prudently, which is interesting if you think about Silicon Valley Bank, because Silicon Valley Bank also had public disclosure requirements under Pillar 3. So the amount of interest rate risk that Silicon Valley Bank was running was out in the open for, I would say, at least 2 years. So anybody who took the time or the patience to go through their reports would have seen the amount of interest rate risk that the bank was sitting on, and could have made an informed decision. So I think it's an interesting question to what degree the information is used. So do an insufficient amount of people read these reports? Should it be disclosed differently? Not sure, but the information essentially is there. So that's pillar 3.
I so enjoy this, and we may have to break this into three parts.
Maybe.
Yeah, I hope you're good with that. So yeah, no, just keep
Absolutely.
going, Eric.
So then categorization of interest rate risk. This is following the regulatory categories. Some banks don't necessarily follow these, but have an own disaggregation of how they think about interest rate risk. So gap risk, we've talked about that, and that's the most obvious one. If you think about Silicon Valley or the savings and loan crisis, gap risk simply means that the assets and liabilities do not reprice at the same time. And repricing here simply means that the interest rate is resetting. So if you have a 10-year mortgage for your house, that means from a liquidity perspective that the cash is committed for 10 years for the bank, but it doesn't necessarily mean that the duration from an interest rate perspective is 10 years. If you've got a fixed rate for 10 years, then the liquidity period and the interest rate period is the same, it's 10 years. But if your interest rate resets every 3 months, so let's say you're paying Saron plus 50 bips, then and this resets at a quarterly frequency, then from a liquidity perspective, the cash is bounded for bounded for 10 years. But from an interest rate perspective, it's a 3-month loan. And gap risk looks at how do your assets relative to your liabilities reprice. And so the savings and loan crisis had long-term interest rates locked on the asset side, let's say for 10 years. But then on the liability side, the funding was repricing at a quarterly rate. And then as rates increase, nothing's happening on your asset side because it's stuck for the next 10 years. And your funding gets more expensive at a quarterly frequency when it resets. And gap simply looks at the gap, literally, between these repricing periods. And that's really the most important one of the 3 categories. Then basis risk refers to the fact that let's assume you've got rid of all of your gap risk because everything on your balance sheet reprices at a quarterly frequency. The question then is, what index does it reprice on? So if, for instance, for some reason you're funding yourself in dollars, and this is related to the Fed funds rate, but you're lending out in euros, which wouldn't be terribly smart, but just for the sake of argument, and euros is repricing on Ester, even though it's repricing at the same frequency, if the basis between these two rates changes, then you're either making a profit or a loss depending on the directionality of the rate. So that's basis risk. And an option risk is a little bit more elusive, but also extraordinarily relevant. That gets disaggregated into 2 subcategories. Automatic option risk refers essentially to derivatives. So when people have options or um, other instruments and they will automatically be exercised when they're in the money. So you exercise the option. That's automatic option risk. And then behavioral option risk, which is the more important one of the two, refers to the behavior of customers. So do people withdraw their deposits? If you assumed in your modeling that the customers would stick around for 2 years and you've assigned that duration to your deposits, but then suddenly you find that in the case of SVB or Credit Suisse, that customer just running out the door, then customers aren't behaving the way you predicted, and that's behavioral option risk. There is also behavioral option risk on the asset side if you have prepayment risk. And there's a lot of differences between the jurisdictions. Again, the US, for instance, you can prepay your mortgage without penalties, but in Switzerland, for instance, it's different. If you prepay your mortgage, then there is a penalty that makes the bank good essentially on the net present value of um, of your loan. So, say you've taken a mortgage at a high interest rate. Now rates go down. In the US, you would simply take a new mortgage at the lower level of rates and pay off the old one. So now you're paying less on your financing. In Switzerland, you couldn't really do that because if you took out a new mortgage at the lower rate, you would have to make good. You would have to compensate the bank for the net present value that it forgoes. So you're essentially paying the same thing. Um, yeah. And then the last category, which is not a regulatory category, but banks, this is pretty much front and center as well in IRBB for banks, is accounting risks. Um, we'll get to that. So you can have positions that offset from an economic perspective, but that are treated differently from an accounting perspective. So even though economically they co-move, if you then look at your profit and loss statement, in absence of doing what's called hedge accounting, you would see P&L swings due to different accounting treatment. So these accounting risks are also treated under IBB, and then foreign exchange risks or FX also sometimes falls under ALM at least, not IRBB strictly, but definitely under ALM.
I just want to focus for a second on this sort of behavioral option risk. So this idea that in the US, by law, any mortgage is repayable as you have the cash. You can reduce the outstanding balance on your mortgage, means that you get these huge mortgage-backed securities that are issued for, $1 billion at issuance, but by the time you get to 5 years in or 10 years in, already half the balances have been repaid, and the banks have to manage that. Um, and of course, the rate at which it gets prepaid depends on where interest rates move. If interest rates are moving up, then the duration of that instrument becomes longer. If
Yes.
interest rates are moving down, and the customer can refinance, there's interplays between the duration of the instrument and the directionality of interest rates, and the duration will change
Yes.
and that's kind of a behavioral modeling thing, I guess, that the banks have got pretty close
Yes.
under control, but it's also a kind of an interest rate risk. Um, so what I want to do, Eric, is that on the next page of your presentation, you're going to move on to these key measures,
Mm.
uh, net interest income and economic value of the equity, which is central to your article as well. And I have a sense that once there you go, it's there. But I have a kind of a hard stop in 3 minutes, and I know that you have a hard stop in about 25. And we've barely scratched the surface, but I feel like if we start on this, it'll be at least 15 minits.
Yeah.
So I think that what I
Let's
want to do
stop
is
it here.
bring this part of our podcast, our video, to a close. And then, we have to get together to do parts 2 and 3, basically. It might be parts 2, 3, and 4. But can I get you, because this will kind of this will be form a sort of its own kind of module.
Yeah.
So anybody who's listened this far, we're going to come back and dive straight into net interest income and economic value of the equity. But how do you feel this has gone? How have we covered? I mean, I feel like we've barely scratched the surface, but if you want to kind of bring it to a close for the viewer as to what we've done, the ground that we've been on, where we've gone, and where we might be going.
I think so. I've enjoyed this extraordinarily. I tend to go through these slides at a highest pace because there's fewer questions, but this is really enjoyable because it also gets me to think and rethink some of the concepts and maybe explain them better. So what we've done is essentially looked at, so we gave a motivation why this is important, taking especially Silicon Valley Bank out, and the case of Credit Suisse is very different from Silicon Valley Bank. We'll get to that at the end of the slide deck, essentially. So people might want to hang out. We looked at the UBS balance sheet prior to the acquisition of Credit Suisse and talked about main products. We dived into the regulatory framework here, covering both the different types of risks, but also where it sits. And then we will start now talking about metrics next time. So I think it's yeah, we're progressing at a very enjoyable pace from my perspective,
Yeah.
and I hope it's the same for you.
Yes, well, for me it is. I can say I hope for the listener, to the extent that somebody does not plan to listen to the subsequent installments, but they are interested in getting in touch with you or staying in touch with you, what's the best way to find you, Eric?
People can reach out on LinkedIn, and I also have a homepage where I post some of my research. So those would be, I think, two good options. And I was thinking that maybe at the end of our sessions, I would just put this slide deck on that web page. So if people are interested, they can download it from there.
That's extraordinarily generous. And obviously, at the point at which this comes out, this may have already been published. We don't, do you know where it's going to be published?
I'll publish it
Finding
on my, pardon?
finding blind spots before it's too late.
No, we're submitting it to an academic journal, which then sets off a lengthy academic review process.
Yes. Are you able to say which academic journal?
I was intending to submit it to Management Science.
Right. Journal of Financial Economics?
Uh, haven't thought about that one. That would be nice as well. I thought Management Science would be nice because they're kind of quantitative. They're very relevant, interested in real world problems, and somewhat financy as well.
Yeah.
But the other one would be certainly good as well.
Well, we'll discuss more, and I'm looking forward to seeing how
Yeah.
it progresses. Thank you, everyone, for listening. Eric, thank you for giving me, for me, I felt like I was in a personal tutorial. I feel like I've gone up a steep learning curve, and I'm super excited to the subsequent sessions. And Nordea, I think I can say that Nordea Bank is very lucky to have you.
Well, thank you very much.
And
Yes, absolutely enjoyable. And thank you to everyone who was listening in.
until next time.
Until next time.